Today, I invite my accountant onto the podcast who achieved the rare feat of becoming a self-made millionaire in his 20s, and he's going to unpack everything financial, business, and wealth creation to help you build your personal brand empire. Gary Brown is the founder of Hatcher Advisory, an accounting firm that does north of $3 million in revenue. Gary and his wife, Jenny, have a property portfolio with 16 investment properties in that portfolio, a 7-figure share portfolio. And Gary's going to share his mindset and decision-making frameworks around building wealth, around growing a business, paying yourself, tax efficiency, all in this conversation. So it's one you might want to circle back and replay a couple of times and have your pen and paper handy. I will also add that some of the advice and opinions that Gary shares are general in nature, and some of the strategies might not be the right fit for you. So make sure that you seek independent professional advice before actioning any of the ideas in this show. Let's dive into the conversation with Gary. Gary, welcome to the podcast.
Thanks for having me, Az. It's a pleasure, as always.
This conversation is a little bit selfish, to be honest. I've come armed with a series of questions that I've masked as for the listeners, but I think you know deep down that these questions I'm asking are for me.
That's right. I think I look at this and go, most of the listeners probably have the similar type of questions anyway. So let's get on with it and let's dive into how I can help support you and all your listeners.
Excellent, mate. Well, I want to start. There's a lot of things happening in the global sense with economics, the financial systems, but I thought a fun starting point for the conversation would be sharing some of the moves you've made financially in the last 12 to 24 months.
From the accounting firm space, I think the biggest change that we have made, and definitely in the last 20 or 24 months, is a lot more training, leadership training with our actual team. You know, the journey of our business for the first 6 or 7 years revolved around a heavily amount of leadership training for myself and Jenny. And then that got us to where we probably 12 months ago, 2.5 million turnover or something. That got us there, but again, extremely stressful type of business. So one of the things that I identified was it's time for the team to take the next step. And if I can't always be me taking the next step. So I decided to start heavily investing in the leadership training of the team. And since I've done that, my stress levels have decreased substantially. So empowering the team to make better decisions themselves, debriefing those decisions and working with the gaps of their decision-making process if they get something wrong, rather than Gary answers every question. That's really the big moves that we've changed in the last 12 to 24 months. And I feel like the business is a better business as a whole. I feel like I work less hours. There's a lot less stress. I've delegated a lot more of the tasks to different team members. In the short term, that cost me profit. So far, back to, fast forward 12, 18 months later, we're back to the level that I would like to be at. So, but less stress.
Amazing. And what about on a personal financial level? I know you've got an extensive portfolio. Have you made any drastic changes to your strategy in the last year or so?
I definitely have. So we exited out of underperforming property assets that we knew, they still made us money. Don't get me wrong, we still made quite a lot of money. We exited out of 3 properties. So I think one property was up for 500K. Other property was maybe 200 and 200 again. So we made capital gains on them and unfortunately paid capital gains tax. But compared to where we saw the market going over the next 5 or 10 years, we did want to be in those three properties. Then we used those funds or the cash that provided. We went out and bought quite a lot of properties. So this was between March and June last year. So we repositioned our property portfolio accordingly. We are currently sitting on, I think, 16 properties, so quite a lot. But now I'm kind of looking at those properties that are getting a much higher rental yield. So the ones we're targeting are between 8 and 12, 13% rental yields in an area that in 10 years' time, I know will have gone up in capital growth. So we're staying away from regional places and we're hitting up more Brisbane, Olympics, 10 years' time. I think that's a sure thing to equal capital growth. We've picked up properties across the road from the water. Again, across the road from water, how do you beat that? So we've been targeting those types of properties and properties that are around $1 million because that is the average house property price in Australia, rather than an apartment that costs $400,000 in Brisbane that has done nothing for 10 years.
Just to clarify, you're 31, right?
I am 31, 32 in May. I think that's right. Yeah.
So just for the listeners, just to paint context, Gary's 31, self-made, he's got 16 properties, and he just gave away an insight into his property strategy. And I know as a client of Gary's in the accounting firm, this is the sort of strategy they like to set their clients up with and sit them down and create a plan for the future. So maybe we should lean into that a little bit. Share a little bit about Hatcher Advisory to paint a picture of what your business does.
So fundamentally, I just like to help people make better financial decisions. So we do that via our accounting firm, via our Chain Financial Services license, but the fundamentals of it is to help people make better financial decisions. So whether that is running a business or whether that is the wealth creation side of things, that is what we're here to do. So even my team, like I do training with my team and I implore them to become financially free, and we do, like they invest, and I encourage them to invest. But it's all about helping people make better financial decisions. That's what the accounting firm's about. We do $3.5 million revenue over a 12-month period. We have 30 team members. We're located in St Kilda, Melbourne, and we have a lot of fun. We play a lot of table tennis. We have a great culture, and we try to enjoy life as much as we can while getting down to business and helping save their taxes and make better financial decisions.
I remember the first time I came into your office and you shared a really simple strategy. I don't know if you're going to share the same one, that if business owners just did this, they'd be set and they wouldn't have to worry about their financial future at the latter end when they're getting towards retirement. So what's a simple strategy for business owners to build wealth?
Definitely a loaded question there. Simple strategy for business owners to build wealth. Take a percentage of the profit and invest it first. In business, we have two choices. We either invest in our current business or we invest outside of our business. So most people need to invest in their business to get to a minimum viable product or to make a certain level of profit. And you have to keep investing in the business to get that level. But once you get to that level, you need to make that decision whether you're going to grow it from $200,000 revenue to $1 million, or you're happy on $200,000 and you just strip out as much profit as possible to put in other investments like shares, property, other businesses. So I would say that the simplest strategy that everybody can do from the start of running a business is to pick a percentage, 5%, 10%, something small, and start investing that money.
Amazing. And keep it simple, right? That's really straightforward. You start with $1 that you strip out and just follow that system and allow time to do its magic, right?
Well, that's Warren Buffett was one of the richest people in the world because of the compounding factor. He donated 50% of his wealth. So I haven't looked at what his wealth is today. I think it's like 130 billion. So it should be 260 billion. So whether that would put him as number one, I haven't looked that up recently, but you look at that and go, that's compounding his wealth from 11 years old and he's in his 90s, right? So compounding his wealth by 24% per year for such a long period of time. And that's what the average person forgets is they go, it's only 5K in shares, I won't do it. But then they don't do it for 20 years in a row. And then they complain that they've got no money for retirement.
So the key is to also stay alive and let time do its thing.
Got to stay alive. You got to look after yourself. You got to be healthy, right? You got to, health is one of the most important levels of wealth, right? You got to be healthy, happy. You got to incrementally start. Like, again, if you start at $1,000 a year in investing, if you think about when you're 18 and you think about if you had enough money to buy a laptop, and this is the one that's been haunting me recently. And I bought a gaming laptop for like $2,000 because that was a smart thing to do back then. And at that point in time, I really only needed to spend maybe $800, $900 to have a laptop that was sufficient to do the work that I needed to do for uni. And if I had put, and I did have the money technically, I could have made it happen, $1,000 or $2,000 into Apple shares. Everyone had iPhones back then that would have compounded to $1,000 compounded now to $36,000. So it's that $1,000 investment. So we all make a series of choices. We all can start with $1,000 and that compounding effect over the long term. If you buy the right investment rather than a risky mining company out of WA that no one's ever heard of, if you buy the right one, the compounding effect could be massive.
I love that advice. And it's just, everyone's got the same choice. It's what you choose to do. And the earlier you start, the better. So I got a great question. And I think this will help a lot of the listeners that are relatively new to business and they might be starting to make a little bit of money. What's a tax efficient way to pay yourself from a business?
in business, there's really three ways to pay yourself. So one, you can do it as a wage. Two, you can do it as a dividend if you run a company. And three, you can do it as a trust distribution if you have a trust. So they're the three different mechanisms you can use. When you think about a wage, in Australia, we would have work cover and we'd have payroll tax if you're above the threshold. So you're penalised by paying a wage to yourself as a business owner because you've got to pay additional taxes or insurance on top of that. So maybe not paying yourself a wage, but paying yourself as a dividend or trust distribution would be the most efficient way for the business to pay you. But then I go back to that whole nutshell of how much money you're paying yourself, how much money you're living off. And at a certain point, once you go over $180,000 in income, you're getting taxed at 47% of that. So if the lifestyle cost is more than $180,000 in income, then that's a very inefficient way to pay yourself. Either method would result in the same taxes.
Yeah, really good insight for those of you that are dipping your toe into business, starting to make a little bit of profit and just understanding what different pathways are. And if you haven't got help from a professional like Gary, an accountant, to get the right structures set up, then that could be a conversation to pursue with someone like Gary, because as you said, depending on how you set up also depends how you can distribute the profits and income from the business. And you shared a great strategy on Facebook the other day for those that have, say, teenagers that are above a certain age that you can do as a business owner that could potentially help pay for their school fees tax-free. So if we've got any listeners that are in that category, did you want to reiterate what you shared the other day?
Sure. So in Australia, to have a job with a random person, it'll be 14 and 9 months, age 14, 9 months. So in business, we're actually allowed to employ our children at any age. But in this context, you've got to be mindful that do they work in your business? Do they help your business? Maybe use their image or their picture to promote your business. And because if you can justify it, if they do work in your business, if you can work out a way to make that happen inside your business, you would be allowed to pay them a wage. And if you're allowed to pay them a wage and a fair wage, well, you would determine a fair wage, you would be able to claim that as a tax deduction from your business perspective. And by doing that, you'd be moving, say, $5,000 or $10,000 of business profit to a child or teenager. You would do the physical transfer. And then that child or teenager makes the decision, well, what they spend the money on. And maybe they go, hey, mum, dad, I want to help you guys out and I'm going to pay for my school fees this year. And because their income would be less than 18 or 20,000, they wouldn't be getting taxed on it, which therefore means if you followed the path of that transaction, the kids would be paying for their school fees, you'd be getting a tax deduction for paying the kids, and those kids would be paying no tax on their income when it's below 18, 20,000 per year.
Really, really cool little tip. If you're in the position to explore that, obviously you need your children to be on board with that and doing it the right way. But I thought that was a really nice share that I saw on Facebook, which brought delight to me because Bailey is now moving towards 7. He will be a teenager in 7 years. So all these tips are going to be very useful when we get to that crossroads. So the next question I want to ask, because again, I've seen you post some really interesting stats and insights into this. Why do property prices keep going up, generally speaking, in Australia?
I believe it's got a lot to do with the population of the country. So if we do migration, legal migration, we bring in 200,000, 300, 400,000 people into the country, and we still have a positive growth rate with our births, people getting born in Australia. Therefore, the number of dwellings that we need in Australia keeps increasing. So on average, we're doing between 150 and 200,000 dwellings a year in Australia. In the past couple of years, we've watched the level of migration to Australia exceed that number substantially. So what it means is we have more people living in Australia than the houses that we're building to provide housing for them. And if you think about supply and demand, therefore the demand has increased, supply is nowhere near increased, there's a gap, that pushes up the house prices. Will it continue into the future? We'll go back to, from a population perspective, we'll go back to what the government does. So each year in May, they announce the May budget. In the May budget, it will tell us how many people they're going to let into Australia from a visa perspective. And I can comfortably say that we're probably going to have close to, I reckon, 100 or 150,000 people, because they did announce that it's supposed to be decreasing. So 100, 150,000 people will net move to Australia in the next 12 months. We're still building 150,000, 200,000 dwellings, but we've got new babies getting born. Therefore, more babies are getting born than people are dying. And therefore, we're still going to have a supply problem in Australia. Double that effect. So everyone's like, but interest rates went up by 3-4% over the last 3 years, 2 years. Why didn't that bring down the house prices? Because we had so many people moving to Australia. If we have interest rates at the same time start going down, people have a bigger buyer power or can go to the bank and borrow more money, which therefore they're able to spend more money buying a house. Double that effect with more people moving to Australia than ever before, house prices have to continue to go up.
Economics and the housing markets given to you on a platter.
And the net effect of all that will be higher rents as well. So again, supply and demand. Less houses are on the market to rent now. Less investors are buying houses to rent out, and therefore rents are going to continue to go up unless they change the legislation in a way that would impact the level that the free market can decide what the rents are, then rents will continue to go up. But if they were to legislate, again, in the favour of tenants, which they've been doing all over the country anyway, less people want to be investors and less people will buy properties, which will then have the opposite effect of what the government's trying to achieve. So one, house prices are going to go up. Two, rents are going to go up. And there are two things that I can confidently say over the next 5-10 years, there'll be no relief in sight. And just in case any of the listeners were following what the federal government had announced a couple of months back about a target to build 800,000 dwellings over a few years, we're already seeing in Victoria's target is going to be nowhere near met. So just because the politicians go out there and make these massive, bold statements of doing the impossible, I wouldn't be betting my hopes and dreams that's going to be pulled off and therefore put enough pressure on the supply side of things. I think the opposite will happen. House prices go up, rents go up, and it will continue to go up until there's a massive shift in the supply side, which I can't see happening in the next 3 to 5 years.
I'll let the listeners read between the lines on the decisions they make with asset allocation into property. So you see hundreds of different businesses sit with hundreds of different business owners every single year. So you see all the mistakes firsthand and probably a theme or a pattern that a lot of business owners make. What would you say is the biggest mistake business owners make when it comes to wealth creation?
If you think about how many billionaires we have in the world, majority of them would have become billionaires because of their business. So the easiest way to build wealth is by having a business. So therefore, the question of the biggest mistake I see in wealth creation by business owners is them not building a proper business. I would say that you've got to get to a minimum viable product in a business which generates a certain level of profit, and that's the number one reason to be in a business. And if you can't get to that level within a reasonable amount of time, which everyone has to determine based on the industry that they're trying to jump into, because it's not the same, each industry is different. But if you can't get to that minimum viable product and have a minimum level of profit, which is probably maybe 90 or 100K, because that's what the average Australian earns in wages, then you probably shouldn't be in business. But then generally speaking, from a business owner perspective, most business owners don't put money into super, therefore they're not doing that super compounding effect, which again, I have no problem with as long as they're doing a strategy outside of super. But most business owners get into the trap of they make $100,000 per year, they spend $100,000 per year on lifestyle, they put no money into super, they don't buy any investments, they don't buy shares, properties or other things, and they just live, again, the mentality of paycheck to paycheck. But once they get to 60, 65, they turn around and say to their accountant, I've no super because I was a business owner. But the reality is you can contribute money into super, you can contribute money into buying shares and to buying property each year, but it's a sacrifice on the lifestyle, and people don't want to make that sacrifice, which is why they never put their long-term needs before their short-term needs, and that's why they never build enough wealth, or the number one reason why they don't build the wealth that they want to build.
And I guess too, when people get towards the back end of their business career or later stages in their life, they've also got some advantages with superannuation and the way that's treated from a tax perspective. Do you want to elaborate on that in any way?
Yeah, so again, as an individual, we're paying between 0 and 47% tax based on our income levels. In a super fund, in a sub-managed super fund, we pay between 0 and 15%. At our ages, we don't want to be loading the super fund up with concessional and non-concessional contributions. We don't want to be putting tons and tons of money in there because it's locked away for 30 years. And to be honest, we can't trust what the government's going to do around legislation and super. But if you're in the back end of your working life, so you're 50, 55, 60, it's a very short-term runway until you're able to access that super, which means that the risk of the government changing something in that short-term period is very, very minimal, which means that if I'm building wealth and I'm 50, 55, 60, my strategy would be heavily around putting money into super and paying 0 to 15% tax on those profits. And again, once we're above, say, 60, mid condition of release, maybe we're not working, we'll be paying 0% tax on the profits we made under the super fund if we have a balance of less than $1.9 million per member. So again, huge benefits in super, and just depends on what stage you're at in life, whether you want to pull the trigger on it. I know myself, I look at my wealth creation and how much assets I've got, and I think just simply put with my share portfolio, 30% or 35% of my share portfolio is in super. The balance is outside of super under a trust. I should, in theory, mathematically load up my super. I think over maybe 2 or 3 years, I could probably push that whole share portfolio into the self-managed super fund, but then I know it's locked away and I can't touch it for 30 years. So compounding effect would be huge from a tax savings perspective, but then if I needed that money for whatever reason, we'd be able to touch it.
Yeah, so again, depending on what season of life you find yourself in, it's really important to have the right financial advisors and accountants in your corner. So this is just pulling up the lid. So even if you're very early in the journey, you can sort of future pace some of the decision making that you might make. And if you've got someone like Gary or Hatcher Advisory and his team in your corner, you can actually create a long-term roadmap around your wealth creation. So you've got a game plan, you've got a target, and you're deliberately creating and knowing what to do with the profits. So I guess the next question that ties into that, what about mistakes with cash flow and money management that business owners make?
I was speaking to a non-client the other day, an operating company, and asked him, does he have a budget for the business? And he turns over $2.5 million per year. And his answer was back to me, as a budget per project, and he was a bit confused about what the budget was for the business. So every business should have a budget for what we're going to spend on expenses and a forecast on what we think we're going to achieve in revenue, and they should be making financial decisions around that budget and forecast. And why that's important is the amount of times I've seen people double their businesses from $1 million revenue to $2 million revenue, and then complain that they've got no cash. It just happens all the time because they're forgetting that they might have gone from 100 grand debtors to now 300 grand debtors. They're forgetting that the working capital, there might be a time delay between, they might be investing all this money on material, wages to produce a product, but now they're producing double the amounts of product and they might only get repaid once a month or once every 6 weeks. And therefore the cost to produce has gone up and it's just sucking the cash out of the business. So without having an understanding of the growth of where you're trying to grow the business, most people just go out there and just go, they just see all this amazing work. They think they're going to make all this amazing profit. And maybe they do on paper, they make the profit at the bottom, but the profit is sitting in the debtors. The profit is sitting in work in progress. The profit is sitting in another balance sheet item other than cash in their bank account. So from a cash management side of things, you've got to be really mindful of when you're going through that rapid growth phase of the business, that it absorbs and it takes your cash. So you can't scale, or you shouldn't scale a shit business that's making no profit. If you're going to scale it and double the size of it, it's still going to be making no profit. Then there's no point scaling. So I think that the biggest mistake I see is people not having a budget and forecast in place, not understanding what the growth is going to be in their business from a cash working capital requirements. And then if they don't have the physical cash already there, they haven't got a facility in place to resolve the issue, an overdraft, working capital finance, debtor finance. They haven't got that in place. And then they change accountants to me. And then I'm like, this is why you have no money. And then we've got to try to get the lifeblood cash back into the business to support the business so it can still thrive through that growth period.
I'll get you to clarify the people that are listening that might be newer to accounting and newer to business, debtors, because that's a term that we've said a lot. So you just want to explain what a debtor is to people that are kind of new to a balance sheet, to invoicing and business?
Absolutely. In business, if we're in the type of business that we invoice someone and then they have to pay that invoice, and they may pay it in 1 day, 30 days, 45 days, it's when the money is outstanding. So when you're owed that money, we call that a debtor. So in this context, I have a structural steel business that I own with my brother, and we're very mindful of revenue. So if we go from $150,000 revenue to $300,000 revenue in 1 month, effectively our debtors are going to double, which means that we're going to go from, say, 100 grand debtors to 200 grand debtors, which means that 100 grand of cash out of my bank account has just disappeared. Because it's literally will be sitting in people who owe me the money. So you can only do that so much based on a limited resource of cash that you've got, or you have to find some type of additional cash to bring into the business to allow that growth to happen.
Amazing. And there's also, for the listeners that are building a personal brand, they might be early stage to business, models like direct debit, where you collect money automatically through a facility like Stripe, can be a really efficient way to not run into those cash flow challenges, or have a model that makes it easy for clients and easy for you on an administration standpoint. I know that part of your model at Hatcher also has a direct debit with some of your clients, isn't that right?
Yeah, so accounting firm that I did my quote apprenticeship at, they were around $2.5 million turnover per year, and they had about $1 million in debtors. So they probably had a year and a half of profit just sitting there in outstanding bills that people owed them. So when we created our accounting firm, we thought, we don't want that. So always we're trying to get to a point where we'd have the least amount of debtors as possible. And then maybe 2 or 3 years ago, we started doing monthly invoicing for the business clients to help with their cash flow and help with our cash flow. Eventually, we went into all of our engagements assigned with a credit card or bank account, so that we can, after the job is completed, within 7 days, we'll then process the credit card payment or process the bank direct debit out of the bank account, and therefore our debtors are sitting around $100,000, $150,000. And if we compare that to the firm I used to work at, which was $1 million, it's pretty damn good. I don't think we'll ever get it to zero, but that's always the challenge, because if you've got $500,000 sitting in debtors that people owe you, that's $500,000 of cash that is in your bank account. And if you logically think about that, is if the money was in my bank account, I could use that to buy another property. But instead of buying another property and getting 10 years worth of capital gains on that property, it's just sitting there in the balance sheet doing nothing until the clients pay. So you've got to work out different strategies to collect that money. And our bank charges, we incur the surcharge if it goes through the credit cards and stuff. It gets quite hexy, but it's still something that we believe as an organization it's worth paying.
And I'll second that. We do the same thing. So clients, we have a direct debit model in our agencies. We absorb the fee that's charged there. But the great thing is we're also not spending administration or labor on chasing up those payments. We've got very predictable cash flow landing in the bank account every single week, which makes management a lot better. You can make more accurate decisions. So a really simple place to start if you're looking to set up a facility to take those payments is Stripe. It's a tool that I recommend, and it's very user-friendly. It takes less than 15 minutes to set up if you've got all your information there. So I just want to share a tool for you if you're looking for a way to set up direct debit and recurring billing payments for your business, which I highly recommend. It's a great model. So we've shared some insane insights into one, business, and also wealth creation. So outside listening to this episode on repeat over and over again, how can business owners increase their financial literacy?
I think it all starts with education, right? So I think all business owners need to continue to learn. So I would look at the business topics like, leadership, management, legals, all that type of stuff. Then I'd look at the wealth creation side. So I would always be focusing on, there's people in the industry that are pioneering this space. You got like Grant Cardone, he's amazing from a property side of things, but unfortunately his property advice is more tailored to the US, and we can't do a lot of the stuff in Australia. But the learnings from that we can apply to Australia. And likewise with Robert Kiyosaki, his books, what I grew up reading and learning from here, again, maybe because it's based in the US, you'd be like, some of that doesn't apply to me, but the teachings definitely do apply in Australia. So I would go back to, you have to continuously learn and learn from those that have done it. Learn from those people that have run a $10 million business or $20 million business, have built $10 million worth of assets, $50 million worth of assets, $100 million worth of assets, whatever it may be that you're aspiring to do. You've got to learn from those others that have done it before you. And I think that's a key part of what my journey's been about is by learning from others, having mentors, having coaches that have done what I want to do.
Next question, I was asking you offline, but we decided to bring this one online for the podcast listeners because I think it's very valuable to get your insight on this. So when you buy shares or stocks, depending on where you are in the world, the terminology you use, you're essentially buying a piece of a company, and you can buy into a company that doesn't pay dividends, with the fundamentals being that the value of that stock, those shares, will grow in the future, or you can invest in companies that distribute dividends so you get paid out some of the profits. So when you're making a decision and you're looking to invest and buy shares or own a piece of a company, do you lean towards companies that cash flow and pay out those dividends, or do you lean towards just the fundamentals and that business growing in value and that stock price going up?
Yeah, this is a really fascinating question, because a company will pay dividends if they don't know what to do with the money. So if they believe that they can't invest that money to make a better return than what their shareholders can, they'll give you back the money. So if you look at NAB for the last 15 years, I bet you'll find that their share price is very similar 15 years ago to what it is today. And therefore, over that 15 years period, they've paid out a high percentage of their profits in dividends. So the question that I would have is, would I prefer to own a company like NAB that don't know what to do with their profits, so they pay it out as dividends, or a company like Quarry that continuously year on year grow their revenue, grow their profits, grow their dividend, maybe not the percentage, but they grow the dollar value that they issue out as a dividend because they have higher profits? Would I prefer to own that type of company, or the one that is just consistently coasting along? In Australia, we have a fascination with high dividend companies. Like, for some reason in Australia, we love the dividend factor. And again, you look at a Telstra. So, some of your listeners might have bought Telstra at, T1 public offering or T2 public offering, or just on the market. I remember I bought it at $4.75, maybe, it feels like a long time ago now, so maybe 6 to 8 years ago. And I kid you not, I bought it because I'd get a dividend. And I've been tracking all of this. So I'm like, you get the dividend, within 3 or 4 weeks, the share price will go back up, and then I will sell out of it. So I'll just be in for, I'll just be in for a couple of weeks. I'll get my dividend. And the dividend got announced. There was a reduction in profit. So the dividend percentage was less, or the dollar value was less, which means the share price went from $4.75 to, I think, $4.30. And then it continued to fall down over the next 2 years to like $2.70 or something. So it took me multiple years, like 3 or 4 years, to get back to a break-even position. And that's when I finally exited out of that silly investment that I made, all because I was chasing a dividend. But again, that opportunity cost of, and I'm cherry picking, so for all the listeners out there, I am cherry picking an example, but that opportunity cost to a company like Amazon that doesn't issue out a dividend, or didn't issue out a dividend back then, because they take the profits, they reinvest it into their business, and they become a $500 million business, a $1 trillion business, and their share price catapults up, right? If you think about in the last, 5, 6 years, the whole Afterpay situation, that company, why could NAB, for example, why didn't NAB create Afterpay? Like, they had the money, they had the banking infrastructure. In theory, they could employ the people that do it. They just didn't know how to do it. They're not an innovative business. So again, when I pick companies to buy in, I follow a few different principles. 1, they have to be like growing their revenue. 2, they have to be growing their profit. 3, there have to be some type of monopoly, or that have to be a big enough brand that they can't get eaten away at. They're really the 3 things that I'm focusing on, because over the long term, if they achieve those 3 outcomes, their share price goes up. There's no way for their share price to go down if they're increasing revenue, increasing profit, and they're still maintaining some type of monopoly or moat around their business. And again, those lessons are taught by Warren Buffett, right? That's what he talks about. And, he does it right. He has a famous thing about Coca-Cola and how much the dividends paid today from Coca-Cola. And the dividends that he gets paid today are some astronomical number compared to the money that he invested in the company. But he never invested in Coca-Cola because of the dividends. He invested in Coca-Cola because 1, it was a monopoly or a duopoly. 2, revenue's increasing. 3, profits are increasing. And therefore, eventually, when that company decides to pay out dividends, a very small amount of dividends, if they still got those 3 factors, the dividend dollar value is still going to increase over years of compounding.
So you can see why working with a strategic firm like Hatcher this is the sort of intel that I get access to as a client when I sit down and we look at the company, we look at how we're paying ourselves, we look at what we're going to do to build wealth outside. And Gary's been very generous to share his mindset. And the reason why I respect it so much is because he lives this stuff. He has the runs on the board. He's 31. He has, how big's your stock portfolio, your share portfolio, or do you want to keep that private?
No, 1.2 million.
There you go.
My view's always been, if I'm open and honest with my financial situation, people who talk to me, they've got to be fine, honest, open and honest about their situation so I can give them the best advice. So it's a bit rich if I turn around and say, hey, I'm not telling you how much money I got in the stock market, but tell me how much money you got in the stock market.
Yeah.
Right? This does make sense.
Full transparency. So we're looking at someone that's got 16 properties, a company that does 3 to 3.5 million, a $1.2 million share portfolio, 31 years old, all self-made from scratch. So it's pretty rare to be able to dive into the insights and the way that someone at that level at such a young age relative to the population thinks about these decisions. So make sure you take notes and circle back through this episode a few times because there's insane value in this conversation. I actually want to steer the chat in a different direction because there's another thing that I'm really, really impressed by you. And it's an area that I just don't have the same level of courage that you do, but you're not afraid to have a very strong opinion. As Gary Brown on social media, I see you post on local MPs, posts on platforms like LinkedIn, even the Prime Ministers, other business owners, other companies. So what's your mindset around posting and sharing your opinions and views? Because you do it at a very high level and you're not afraid to have confrontation.
I believe that we can all learn or we can all improve our mindset by having conversations and discussions. So I'm very strongly opinionated, but doesn't mean I'm right. So I'm more than happy to be challenged on the ideas that I've got, and you'll see, and I will have a discussion. As long as people are being respectful, then I will have a discussion about what it may be. And too many people, probably globally, but too many people in Australia are too scared to voice their opinion on topics, which means that the general public don't believe or don't know that there are people out there that have those opinions. So like before I said, we're talking about immigration. If you look at the immigration conversation from one part and go, well, immigration into Australia results in higher house prices, higher rental prices, which means it's bad for anyone that doesn't own a house. Immigration is really bad. And then if you look at it on the other flip side, which means that the only reason why Australia hasn't gone into a recession in probably the last 10 years, since 2014, potentially, is because of immigration. So we've brought people into this country to prop up our country. It means we didn't go into a recession, which means all of us have benefited from a better lifestyle than what we otherwise would have had without immigration. So I am, again, happy to have opinions on different topics and be challenged on those opinions, because I don't see enough people out there holding our politicians, or two, other businesses accountable for their stupidity, but like for their actions that they're taking. In very simple terms, and I'm happy with my thought on this, but in the US, if you're a Republican or a Democrat, whichever one you are, and you speak out, you're going to alienate half the country. And that half of the country won't buy from you or won't do business with you. And it's pretty much what happens in the US. In Australia, it might be like that, but I want to work with people that want to make better financial decisions. So if they read my content and my content resonates with them and they go, well, this all makes sense to me. I like making money. I want to make money so I'm financially free. I don't want to be working until I'm 80 to pay my bills. Then I'm going to go speak and work with someone like Gary. But if they have the mindset that we should pay every dollar that we make above $100,000 to the ATO so that we can have better social systems, so we're more of a socialist country, then they probably shouldn't come work with me. So you can get a lot by the different content that I write. We'll steer away people, so people that won't work well with me, and it will draw in people that do work well with me. So, yeah.
And definitely follow Gary. Will put all those links in the show notes below so you can see what I'm talking about, because he does give away financial advice. He does share his views very consistently. So if you've enjoyed this conversation to this point and you want to continue peeking under the hood, then make sure you're following Gary on social media, because you'll get access to this on a daily basis. He's quite prolific with his content. On that note, what's your vision for your personal brand as Gary Brown? Clearly, you're set up financially, you've got choices. So what's motivating you? Where do you want to take Gary Brown as a personal brand?
I think about the impact and financial literacy, right? So one of my big goals in life is to be able to teach financial literacy to a wide platform of people in Australia. So I look at our education system, both our high school system. I was in public school and private school, so I can comment on both of them. And I was also at university studying accounting, right? So you would think that accountants would be quite good at financial literacy after they do an accounting degree, but I believe that both of those systems are failing to teach financial literacy to the level that Australia, the general public, needs. So the vision for my personal brand is to continue to help educate people on a larger scale for financial literacy. And each year I kind of take another step forward with that, and I devote more hours each year in the week to that mission, and therefore the personal brand is that's where that's going. So at some point I'll write a book. At some point I'll do regular webinar series on financial literacy again when I have more time, and getting up on stage talking, helping people make better financial decisions.
And I think when you're driven by that purpose or that mission, it makes showing up so much easier. And that's been one of the themes on this podcast, is finding your calling and having something that drives you that's much bigger than money. And you're clearly living that. And we're big on leading from where you live, leading by example. And that's why I was really excited to have this conversation. Is there one tip you'd like to leave the audience with?
The most impactful thing that you can do today to change your future would be starting investing in yourself. So if this episode of the podcast has got you piqued your interest around the wealth creation side of things, then go out there and do more education on it. And if you already have a really good fundamental understanding of the shares and property, then start investing. Don't wait until next week. Don't wait until next month. Don't wait until the house market has crashed, because we've gone into, we had a COVID period. The house price is going to crash. We're going to buy a house 50% less, and it never happened. Since then, the house price, went up at nationwide 8.1% last year. Bought $1 million house. It's up to $1,081,000. So just start. So start investing either in yourself and learning, or start actually investing in wealth creation activities.
That's been a recurring theme throughout the entire podcast. Get started. Stop sitting on the sidelines with building your personal brand, with creating content. Now, Gary's relaying that same message when it comes to wealth creation and investing. So you guys hopefully are getting that message drilled in. How can people get in touch? If they've listened to this point into the conversation, clearly they're extracting a lot of value, and no doubt they're probably curious about how they may be able to get access to Hatcher or to you.
If you jump on the website, www.hatcher.com.au, hatcher.com.au, you can follow the links and get in contact with us that way, or just on social media. So again, if you reach out to me, Gary Brown, on Facebook or LinkedIn, I'm always the one that responds. So I'll respond and direct you where you need to go.
Amazing. And we'll put links to Hatcher in the show notes below so you can find that. And I'd also like to finish by giving a massive plug to Hatcher and to Gary. They've been managing, both myself and Paula, our entities and our structures and our accounting for maybe 4 or 5 years now. And
wow.
Yeah, and just the advice, it's not just accounting and compliance and lodging the paperwork. They sit down and strategically help you make those decisions, and you got to look at some of the advice at a sort of a general level today. But when you sit down in the room and they're looking at your finances, your cash flow at a personal level, and looking at your goals and what your vision is as a family, as an individual, and helping create a roadmap to that, it's invaluable. So I highly endorse them as someone who is a client, and you're not going to have a better accounting team supporting you to grow your business and make wealth creation decisions. So I'll leave you on that note. As always, if you've enjoyed this episode, make sure you're following to get access to future episodes on demand. And if you can leave a 5-star review on the platform that you're listening on, that'll help more people discover the show.